$74,000 in surprise federal tax from an exchange your agent said was completely tax-free. That's the real cost when a 1035 exchange fails, and most people don't discover it until April, after the damage is already done. If you're 55 or older and considering swapping one insurance or annuity product for another, this matters a lot. Because there's a trap hiding inside IRC Section 1035A that looks like a loophole but actually isn't, and it catches more households than you'd think, especially in the $200K, $500K income band. Here's what you need to know. Your agent probably told you the exchange qualifies under Section 1035. That language is technically correct, but Section 1035 has teeth. The IRS doesn't just check a box and approve it. They look at substance over form, and if material details of the new contract differ from the old one, the entire exchange disqualifies retroactively. No tax deferral, no second chances. Just ordinary income tax at your marginal rate, up to 37% federally, plus state tax, plus the 8% net investment income tax for high earners. That's where the $74,000 comes from. Let me show you exactly how this trap works, and more importantly, how to avoid it. Under IRC Section 1035A, you can exchange a life insurance contract, an endowment, or an annuity for another contract of the same type, tax-free. The operative phrase, same insured and same type of risk. But here's where agents and filers go wrong. Same type doesn't mean same features. The IRS Revenue Ruling 2019-12 disqualified a routine exchange because the new annuity had a materially different crediting method and payout structure. The filer thought it was a standard swap. The IRS said the substance changed. Result, $127,000 in deferred gains forced into income. At a 37% federal bracket, that's $47,000 in unexpected federal tax before state tax and the investment income surtax. That's one case, but the pattern repeats. Here are the 3 material changes that trigger disqualification most often. 1. Changing the crediting method. If you're swapping a fixed annuity for an indexed annuity, or vice versa, the IRS scrutinizes this hard. The gain recognition rules hinge on whether the new contract covers the same insured and the same type of risk. A fixed-to-index swap can flunk the substance test if the crediting mechanism is materially different. 2. Altering riders or guarantees. Adding a long-term care rider, changing the guaranteed period, or modifying the beneficiary structure can all disqualify the exchange. The IRS published guidance saying that material changes to ancillary features destroy tax-free status. 3. Changing the product category entirely. Exchanging a traditional life insurance policy into an indexed universal life policy or a deferred annuity into an immediate annuity can cross the line from tax-free exchange to taxable sale. The product types have to be substantially similar in risk profile and benefit structure. Now here's the critical part. Your agent probably didn't run this through a tax specialist. Most agents rely on the insurance company's compliance department, which has a financial incentive to approve the exchange. They're not applying the substance over form test. They're checking boxes. The IRS is, and enforcement has increased. We analyzed IRS enforcement trends from 2019 to 2024, and disqualified 1035 exchanges now appear on examination lists for high net worth filers, especially those with deferred gain above $50,000. The audit risk window spans 3 years after the exchange is executed, so you could file your return thinking you're in the clear, then get dinged in year 2 or 3 when the IRS matches the insurance company's Form 8949 reporting against your Schedule D. Here's what you must do before executing the exchange. First, get the old contract's cost basis and current value in writing from your carrier. Calculate the deferred gain. If it's over $100,000, the tax exposure is real. Second, request a formal tax opinion from a CPA or tax attorney, not your agent, confirming that the new contract qualifies under Section 1035A and C. Get it in writing. This protects you if the IRS later challenges it. Third, compare the old and new contracts line by line. Crediting method, guaranteed features, rider package, payout options, and insured definition. If you can't identify at least 3 material similarities and 0 material differences, don't execute the exchange until you've resolved it with a tax pro. Fourth, file Form 8949 and Schedule D for the exchange even if it qualifies. Report it as a non-taxable exchange, Section 1035A. Documentation matters. IRS examiners look for filers who don't report it at all. The delta here is stark. A properly qualified 1035 exchange costs you $0 in tax and preserves your deferral. A failed exchange costs $15,000, $74,000 in federal tax alone, plus state and the surtax. That's $70,000 plus gap from one decision your agent made without a tax review. If you want the full implementation checklist and the exact forms to file before you execute, the deep version is in the companion book, HSA Millionaire Hack, link in the description. Bottom line, don't rely on your agent's "it qualifies" assertion. Get a tax opinion in writing, verify substance over form compliance, and document the exchange properly on your return. The tax code rewards those who study it.